The macro backdrop has been different to what made you bullish in the past. What made you the most bullish in the past is when growth went up without inflation, and that was very good for equities and possibly bonds for the 60-40 portfolio. That's something we've been accustomed to for like the last cycle, the last 20 years. And this year didn't have that flavor. It felt like growth didn't go anywhere. Yeah. The consumer has been resilient. Manufacturing has been very weak. So if you look at growth, there's not much to be excited about. But I think what's been important is the disinflation momentum, which has continued. And our economists have been very much of the view that you can have disinflation without the growth damage. And most people didn't expect that. Most people expected if you fight inflation, you will have to sacrifice growth. And the fact that you had inflation coming down with growth being relatively resilient, helped a bit by AI, you had what I call an inverse Goldilocks scenario, where inflation actually has come down without hurting growth, which means as a result, the growth inflation mix has improved nevertheless. So I think like the macro backdrop has actually improved, even though it doesn't feel like it if you just look at growth.
So is that why the risk appetite then has gone higher, particularly according to your own measure then? I mean, the risk appetite seemingly picking up quite materially, despite all these unknowns that we actually have in this market, even not knowing where rates are going to go actually, despite us saying, yes, they're reaching the end of their tightening cycle, still don't know how long they're going to stay there for example. We don't know where the end points are for some of these as well. But still, that risk appetite getting higher.
No, I think you're absolutely right. Coming into the summer, at the end of July, our risk appetite indicator reached one of the highest levels we've seen pretty much since the COVID crisis. And that worried us a bit. So the market took the soft landing, the growth resilience with disinflation, kind of reaching the end of central bank tightening cycles as a very positive, and maybe got a bit too bullish. And then in August, you had this move in longer dated rates, which wasn't even driven by the inflation picture. It wasn't even driven by central banks, and that was something new, and that kind of put a bit of a dent into risk appetite, and since then it's normalized a bit. So that risk appetite indicator is, I would say, roughly at neutral levels. But you're absolutely right, like 2-3 weeks ago, it was a bit elevated, and we were worried that the market was getting a bit too bullish on this inverse Goldilocks scenario.
So where does that place allocations then at this stage? I mean, does that say then you get into equities which seem to still have some sort of juice in them, despite having run hard in many parts of the world, especially in the US?
I would say that right now is the time for balance and not taking too aggressive beta bets. So we are currently neutral equities, we're neutral bonds. So you could say we're going back to 60-40. You might remember we had chats on this in the past that we were very worried about 60-40 coming into 2022, and then you had that big drawdown. And I think now you're in a much better spot with regards to these type of portfolio approaches, because the bond market can buffer equities if you have disinflation. We're not particularly excited about growth. We have to be clear, growth is likely to come down a bit further. You saw the data this week out of Europe. You start to see the services sector slowing as well. So I don't think it's an easy thing to say that you want to be bullish equities. There's certainly areas within the equity market that are maybe not that cyclical, as we learned yesterday with NVIDIA's results, that have structural growth. And if you find any areas that are mispriced, that are cheap in structural growth, that might be worthwhile. But I think we're relatively neutral on equities as well.
We're going to touch on